There's a company that owns a piece of your bank, a piece of your phone company, a piece of the grocery store you shopped at this morning, and possibly a piece of the house you're sitting in right now. You've never voted for its executives. You've never signed a contract with it. Most of you have never even heard its name spoken out loud. By the end of this video, you're going to look at your bank statement, your 401k, and even your neighborhood completely differently. In 1986, a young bond trader named Larry Fink was one of the golden boys of Wall Street. He worked at First Boston. He was on track to run the place. Then his team made a bet on interest rates. The bet was wrong. First Boston lost $100 million in a single quarter because of Fink's desk. He wasn't just embarrassed, he was humiliated in front of the entire firm. And he learned something that would define the rest of his career. Nobody understood risk. Not the traders, not the executives, not the banks. Everyone was flying blind, guessing with other people's money. So in 1988, Fink did something almost nobody does after a public failure like that. He didn't quit finance. He started a new company with 7 other partners with one specific mission: build a machine that actually understands risk before it happens. They called it BlackRock. At the time, it wasn't even a real company. It was a few desks inside another firm, Blackstone, which lent them office space and $1 million in credit. Nobody expected it to become anything more than a boutique bond shop. But here is where things took a turn nobody saw coming. Fink's team built something internally, not a fund, not a product, a piece of software. They called it Aladdin, short for Asset, Liability, Debt, and Derivative Investment Network. Think of Aladdin as a giant nervous system for money. You feed it a portfolio, stocks, bonds, mortgages, currencies, anything, and it runs millions of simulations. Wars, recessions, interest rate shocks, currency collapses. It tells you, before disaster hits, exactly how much you stand to lose and where the risk is hiding. In the late 1980s and 90s, this was revolutionary. Most firms were still using spreadsheets and gut instinct. BlackRock had a supercomputer quietly modeling the future. And then came 2008. The financial system didn't just wobble, it nearly died. Banks that had existed for a century collapsed in days. Lehman Brothers, Bear Stearns, AIG. Nobody in Washington actually understood what was inside these companies' books. The mortgage-backed securities were so complex that even the banks that created them didn't fully understand their own exposure. So who did the US government call to figure out what was actually inside these toxic portfolios? BlackRock. The New York Federal Reserve hired BlackRock to analyze the very assets that were destroying the financial system, the toxic mortgage bonds sitting inside Bear Stearns and AIG. The US Treasury brought them in too. So did the Swiss government. So did the Irish government when their banking system collapsed. Let that sink in for a second. In the biggest financial crisis in modern history, governments didn't just regulate the players. They hired one of the players to tell them what was going on. Most people think BlackRock is just a big investment company, but the reality is stranger than that. During the one moment in modern history when the entire global financial system nearly collapsed, one company was in the room with the Fed, the Treasury, and foreign governments, holding the flashlight. Here's where the story shifts from important company to something much bigger. In 2009, right after the crisis, BlackRock bought a company called Barclays Global Investors for $13.5 billion. Tucked inside that deal was a product line most people had never heard of, iShares. iShares was one of the pioneers of something called the ETF, the Exchange Traded Fund. And this single acquisition quietly turned BlackRock into the largest owner of index funds on planet Earth. Now, why does that matter so much? Let me explain it simply. For most of history, investing meant picking stocks. You research a company, you believe in it, you buy shares. That's called active investing. But starting in the 1990s and exploding after 2008, a different idea took over. Instead of trying to beat the market, why not just own the market? Buy a little bit of everything, every company in the S&P 500, and let it ride. This is called passive investing, or index investing. And it is, statistically, one of the best financial ideas of the last 50 years for regular people. Lower fees. Better long-term returns than most professional stock pickers. It democratized investing for millions of everyday Americans. But here's the twist nobody talks about. When you buy an index fund, you're not managing your own money anymore. BlackRock is. And when you multiply that by tens of millions of people, all pooling their retirement savings into the same handful of giant funds, BlackRock ends up holding enormous stakes in almost every major public company in America. Not because BlackRock went out and aggressively bought these companies one by one, like a corporate raider, because tens of millions of ordinary people, through their 401ks and pensions, handed BlackRock the money to buy a little piece of everything, automatically, every single month, for decades. Let's talk actual numbers, because they're almost hard to process. As of recent filings, BlackRock manages somewhere around $11 to $12 trillion in assets. To put that in perspective, the entire annual economic output of Japan, the third largest economy on Earth, is smaller than what BlackRock manages. Now, it's critical to understand what this number actually means, because this is where a lot of people online get it wrong. BlackRock doesn't own $11 trillion. Its clients do. Pension funds, governments, university endowments, and everyday people saving for retirement. BlackRock manages it on their behalf, but managing the money means something very specific and very powerful. It means BlackRock controls the voting rights attached to all those shares. When you own a share of a public company, you get a vote. Who sits on the board? Whether to approve a merger, executive pay packages, climate policies, almost every big decision a company makes. When your retirement fund owns Apple stock through a BlackRock index fund, you technically own a sliver of Apple. But you don't vote. BlackRock votes for you. Now spread that across nearly every major company in America, and you start to see the shape of something enormous. Research on this is genuinely staggering. Multiple academic studies, not conspiracy blogs, actual peer-reviewed research from places like Harvard and the Federal Reserve, have found that BlackRock, along with two other giants, Vanguard and State Street, together known as the Big Three, are collectively the largest shareholder in roughly 90% of S&P 500 companies. 90%. One study projected that if current trends continued, the Big Three could someday cast something close to 40% of all shareholder votes in the entire S&P 500. That's not a conspiracy theory. That's math, published in finance journals, done by researchers, who mostly agree the trend is concerning, not secret. If you want to see BlackRock's quiet power actually flex in public, not in theory, not in an academic paper, but in a real boardroom, you need to hear what happened to ExxonMobil in 2021. A tiny hedge fund called Engine No. 1 decided Exxon wasn't moving fast enough on climate strategy and was mismanaging long-term risk. Here's the wild part. Engine No. 1 owned about 0.02% of Exxon, a rounding error. On its own, it had almost zero power to change anything. So it did something clever. It didn't try to buy more shares. It ran a campaign to convince the big shareholders, the ones who actually had the votes, to back its plan to replace board members with people who'd push Exxon toward a different energy strategy. And this is where BlackRock stepped in. BlackRock owned roughly 6 to 7% of Exxon at the time, mostly through index funds holding the retirement savings of ordinary people who'd never heard of Engine No. 1 and never cast a single personal vote on the matter. BlackRock's internal investment stewardship team reviewed Engine No. 1's case and decided to back 3 of its 4 board nominees. When the votes were counted, it wasn't even close in terms of drama. It was one of the biggest shocks in corporate America that year. A fund holding a fraction of a percent of the company had just successfully replaced members of the board of one of the largest oil companies on Earth, essentially because the Big Three index giants sided with them. Think about what that actually means. Nobody who owned Exxon stock through their 401k got a phone call. Nobody got to vote directly. A handful of people inside a stewardship division at BlackRock made a judgment call that reshaped the leadership of a $250 billion oil company, a decision felt by employees, shareholders, and honestly the entire energy market. Was that good? Depends who you ask. Environmental groups called it a landmark win for climate accountability. Oil executives and some free market conservatives called it proof that a handful of Wall Street firms were now dictating energy policy without ever facing a single voter. Both reactions are pointing at the same underlying fact. One company's internal vote reshaped a piece of the real economy, and almost nobody watching from the outside had any say in it. By 2022 and 2023, BlackRock had become something unusual for an asset manager, a genuine political target, attacked from multiple directions at once. On one side, several Republican-led U.S. states, including Texas, Florida, and Louisiana, pulled billions of dollars in pension and state funds out of BlackRock, accusing the company of using its shareholder votes to push climate and ESG priorities on companies at the expense of maximizing returns. Some state officials called it a form of unelected policymaking disguised as investing. On the other side, environmental groups and some progressive politicians accused BlackRock of exactly the opposite, of not doing enough, of talking about climate risk publicly while continuing to hold massive stakes in fossil fuel companies, and voting against many climate-related shareholder proposals in later years. Larry Fink's response, in interviews and annual shareholder letters, was that BlackRock is not an activist and not a political actor. It holds what its clients ask it to hold and votes based on what it believes protects long-term shareholder value, not political ideology. By 2024, BlackRock had even scaled back its use of the term ESG entirely, and shifted more voting power on certain proposals directly back to its institutional clients through a program letting them choose how their own shares are voted. Here's what's fascinating about that last detail. Essentially, in response to years of pressure from every political direction, BlackRock started trying to hand some of its enormous voting power back. Which tells you something important. Even the company at the center of this story seems to understand how uncomfortable that concentration of power looks from the outside. So here's the real question. Is this a secret evil plan? Or is it something scarier, an accident that nobody fully planned, and nobody quite knows how to stop? Let's look at where this power actually shows up in your life. In 2021 and 2022, a story exploded online. BlackRock is buying up all the houses. It went viral. Politicians in multiple countries even repeated it directly. Here's the more accurate version. BlackRock itself, the parent company, was not the one buying up thousands of single-family homes directly. That was largely companies like Invitation Homes and other institutional landlords. But, and this matters, BlackRock, through its massive index funds, is one of the largest shareholders in several of those very companies. So while the headline "BlackRock buys your neighborhood" was an oversimplification, the underlying truth is still uncomfortable. Its sheer size, BlackRock ends up as a top shareholder in the company's reshaping housing markets, insurance markets, grocery chains, hospital networks, and defense contractors, often all at the same time. Look at Invitation Homes alone. It owns roughly 80,000 single-family rental homes across the U.S. Institutional investors, as a category have been estimated to already own a meaningful share of single-family rentals in some markets, and analysts have projected that share could keep climbing in the years ahead if the trend continues. BlackRock's funds are listed among the top institutional shareholders of that company, not because BlackRock's executives decided to corner the housing market, but because Invitation Homes is in the index, and index funds buy everything in the index automatically, without asking whether it's a good idea for the local family trying to buy their first home down the street. That's the mechanism people miss. It's not a decision. It's math running on autopilot at a scale nobody designed for this outcome. Remember that risk software from the 90s? It never stopped growing. Today, Aladdin doesn't just manage BlackRock's own money. Outside firms, banks, insurers, other asset managers, even rival investment companies pay BlackRock to use Aladdin to manage their money too. Estimates have put the total assets tracked or influenced by the Aladdin system at well over $20 trillion. Some estimates run even higher when you count every connected institution. That means a huge slice of the entire global financial system runs on risk calculations from one piece of software, built by one company. BlackRock has advised the Federal Reserve. The European Central Bank hired BlackRock to help design its climate risk stress tests. The company's executives regularly move in and out of senior U.S. Treasury positions, a pattern critics call the revolving door, and defenders call simply hiring the most qualified people in finance for public service. Both things can be true at once. That's what makes this story genuinely complicated, not a cartoon villain plot. Here's where I want to be honest with you, because too many videos on this topic go for shock value instead of the truth. BlackRock did not sit down in 1988 and plan to quietly dominate the global economy by 2025. What actually happened is more unsettling in a different way. A series of individually reasonable decisions. Build better risk software. Buy a great ETF company. Help governments during a crisis. Ride the index fund wave that was genuinely good for regular investors. Compounded, decade after decade, into something so large that no single person, including the people running BlackRock, can fully see or control its total footprint. Larry Fink himself has publicly acknowledged the scale creates real scrutiny. BlackRock has repeatedly stated it doesn't run the companies it invests in, and generally votes in favor of existing management on most proposals, and that its clients, not BlackRock itself, are the true economic owners of the shares. Critics respond that regardless of intent, concentrated voting power in a handful of firms is a structural risk to competitive markets and democratic accountability. Whether or not anyone is plotting anything, both the defenders and the critics are, in their own way, right. That tension, a system too big for good intentions or bad intentions to fully explain, is the actual story. And maybe that's the most unsettling part of all. It's not a secret cabal in a smoky room. It's your own retirement account, multiplied by 80 million other people's retirement accounts, quietly stacking into something too big for anyone to fully steer. Next time you check your retirement account, look closely at the fund name. There's a good chance you'll see 3 letters tucked into the fine print: iShares, or a fund managed by BlackRock. You didn't do anything wrong by investing that way. In fact, it was probably one of the smartest financial decisions you ever made. Index investing built more wealth for ordinary families than almost any financial innovation in the last century. But it's worth sitting with the strange truth underneath it. The same system that makes one company a top shareholder in almost every corporation on Earth. We didn't get here through a secret plan. We got here because millions of individually smart decisions, yours included, added up into something none of us fully see from the inside. That's the real story of how BlackRock quietly owns the world. Not a villain, a mirror. Here's one more thing to sit with before we close this out. Every single mechanism we walk through today, the index funds, the shareholder votes, the risk software running trillions in the background, the political tug-of-war over ESG, none of it required a conspiracy. It only required scale. And scale, once it crosses a certain threshold, starts behaving like power, whether anyone intended it to or not. That's a pattern that shows up again and again throughout financial history, not just with BlackRock, Standard Oil, the railroads of the 1800s, the too big to fail banks of 2008. Every generation discovers, usually too late, that something built to serve people quietly grew large enough to start shaping the ground they stand on. The question worth asking isn't, is BlackRock evil? It's, what does a healthy financial system do when any single institution, however well-intentioned, becomes this important to how the whole machine runs? Nobody has fully answered that question yet. Regulators are still arguing about it. Politicians on opposite sides of the aisle are still fighting over it. And in the meantime, the machine keeps running, every single month, funded by paychecks like yours and mine. If this kind of story gets under your skin the way it does mine, the moments in history where money, power, and ordinary people's decisions collide in ways nobody fully planned, that's exactly what this channel is built around. I'm not here to sell you outrage. I'm here to dig through the boring filings, the dense academic studies, and the actual paper trail, so you get the real story instead of a 30-second clip stripped of context. Every week, we take one thread like this, a company, a crisis, a decision made in a backroom decades ago, and pull it until you can see the whole shape of it. If you want to actually understand how the modern financial world got built, instead of just reacting to headlines about it, subscribe. And join us. This is where the financial history nobody taught you actually gets explained. And if this one made you rethink something you thought you already understood, that's exactly the reaction I'm chasing every time I sit down to write one of these. Drop a comment telling me what surprised you most, the Exxon story, the 90% stat, or the housing angle. I read every one. And honestly, some of the best future video ideas on this channel have come straight from comment sections like this. I'll see you in the next one.